Hello everyone, this is the Dividend Portfolio, and this week we're going to take a look at PepsiCo. So we're going to take a look at the company's financial history, the core business, the future growth avenues, valuation dividends, additional risk with the company, and then finally I'm going to give some final thoughts and also a disclaimer. Alright, let's get started. So in 2001, PepsiCo acquired the Quaker Oats Company. And we can see for PepsiCo here that the 2000s to 2010s were a period of pretty strong growth for the company. The company saw pretty solid growth in revenue, gross profit, and net income. And part of this was due to the integration and expansion of these products from the Quaker Oats Company. Following the 2009-2010 region, PepsiCo acquired a large percent of their major bottling operations in the United States. And so this was, you see here, a jump in long-term debt associated with the acquisition of these primary bottling centers in the United States. So they had a very integrated model at this point. It's also fair to say that their primary competitor, Coca-Cola, was doing about the same thing around the same time as well. So they were also very integrating around this decade. So following the integration, PepsiCo has had rather slow growth. So the compound annual growth rate from 2010 to the end of 2019 has been about 1%. So this is the same for revenue, gross profit, and net income. So we can kind of see here that PepsiCo has a history of providing growth, and the growth has been a little bit slower over the last few years, but it's been pretty consistent in terms of revenue, gross profit, and also net income. Should also state here that the long-term debt here is very reasonable. It's a little shy of 40 billion, but it's very reasonable for a company as large as PepsiCo. So look at the core business. PepsiCo can really be broken into three primary divisions. They have their Frito-Lay division, which is responsible for selling a lot of branded snack foods. So for instance, they have Lay's potato chips, as shown here in the figure. They have Frito corn chips. They have Dorito tortilla chips, branded dips, and many other snack items. Additionally, their second business unit is their Quaker Foods business. And Quaker Foods came with that acquisition we discussed in 2001, and it's responsible for selling a bunch of oat and grain related foods. So this includes things like the Quaker Grits, oatmeal, granola, the Aunt Jemima mixes and syrup, the Captain Crunch cereal, and also Life cereal. And finally, I think we all know that they have this the beverage component here, which we're all familiar with, where they do sell a number of energy drinks, sports drinks, carbonated sodas. And so, of course, their main brand here being Pepsi, but they also have Mountain Dew, Sierra Mist, Tropicana, energy drinks through their Rockstar acquisition. So let's take a look at how these divisions actually perform. Essentially, there's been very strong growth in the Frito-Lay's North America division. So over the last few years, there's been a steady increase in operating profit for this segment. Additionally, there's been good growth for the European segment. So this segment we see here over the last 3 years. When we take a look at the breakdown of the total operating profit by division, what we see is that the Frito-Lay division in North America makes up nearly 50% of the total sales for the company. And you compare that to the rest of the divisions here. So we also have the PepsiCo's Beverage North America division, which makes up 13.9%. And we also have the Quaker Foods North America division, which makes up almost 7%. So you can right away see that that the company does have quite a bit of United States exposure. So this is about 70% of their sales do come from the United States. But that also being said, they do have a lot of strong sales outside the United States. What's interesting, though, is when you look at the gross and net margins of the company over the last decade. So look at PepsiCo here and comparing them to their primary competitor, the Coca-Cola company, so KO here, and we have PepsiCo here, PEP. And so essentially when we look at the gross profit margins of PEP, we can see that it's been pretty stable over the last decade. It's very little variability, it's been healthy 50 to 55% of the company. And correspondingly, when we look at the net margins for PEP, we can see they've also been pretty stable. They've been fluctuating around 10% on average. Interestingly, when you compare the gross profit margins and the net margins with their competitor Coca-Cola, what you'll see is that Coca-Cola consistently has higher gross profit margins, and they additionally have much higher net income margins as well. So in terms of profitability and efficiency, Coca-Cola is typically higher, although they are much more variable than Pepsi. So from this, Pepsi is clearly a very stable and financially healthy company. But that doesn't quite tell the full story when you look at Pepsi and Coca-Cola. When you looked at the Q2 results, so this is revenue brought in Q2, 3 months ended, what you can see is Pepsi's been steadily increasing over the last few years. And between 2019 to 2020, for this Q2, we see that there's about a 3% drop here. So there was a very small decrease in revenue. Whereas Coca-Cola has fluctuated a bit more. They've been stable between 2017, 2018, 2019. But between 2019 and 2020, there was almost a 30% decrease in revenue. And this really goes to show you just how Coca-Cola's processes, they've switched to a really concentrate sales, which is involved in selling their products and syrups to cafes, restaurants. McDonald's is a huge consumer of their concentrate products. So they've really moved it to that model, which is very efficient under normal operations. But in the case where we've been with this global shelter in place, you can see that that's actually hurt their business quite a bit. So let's look at the future growth opportunities for PepsiCo. So one of the company's recent acquisitions is Be & Cherry. And this is really a food and snack company located primarily in the Asia region. So this one increases the number of their products, and two, also expands kind of their international presence in the Asia region. The second recent acquisition is Pioneer Food. And Pioneer Food sells different types of food and beverages in the South African region. And finally, this company has also made a number of different types of beverage acquisitions to expand and support their key products. And this will have, I think, kind of an effect for the company globally, but especially in the United States. So we can kind of see here that some of the recent acquisitions and expansion of products has really been targeting and expanding their new product lineup. Furthermore, I think it's also important to bring up at this point that there's expected to be a lot of growth in the global energy drink market and also the global non-alcoholic beverage market. And so PepsiCo, by expanding their products, supporting some of their key products, and also expanding their product sales globally, I think is in a position to tap into some of this market growth. So let's take a look at the valuation and the dividend for the company. So as of last Friday, the current PE ratio for the company is at about a 25.5x. This is on a forward adjusted basis. So we can see over the last decade that this has been much higher than the average PE ratio of the company. Companies typically within the 22 to 23 range. Additionally, when we look at the starting dividend yield, this is about fair. On average, the company has a starting dividend yield over the last decade of about 3%, and we can see that as of last Friday, it was also about 3%. So it's about fair on a current starting dividend yield. From 2010 to 2015, had increasing free cash flow, which is a very good thing. But from 2015, over the last few years, there's been a decreasing amount of free cash flow. So the free cash flow has been dropping steadily. And as of 2019, the free cash flow barely covered the dividend. And as of 2020, 6 months in, the free cash flow did not cover the dividend by really any extent. And although it's important to keep in mind for PepsiCo that their best sales occur in the third quarter, so this upcoming quarter, and their worst sales typically occur in quarter one. So this half-year point is not a good measurement to see how well the free cash flow is covering the dividend. But there's kind of been this trend of decreasing free cash flow, and that's something I think that's important to keep in mind. I think the company makes enough money to support their dividend, but it's important that they start switching this free cash flow situation around. PepsiCo does come with some risks. So there's been a move by different governments across the world to impose an excise tax on beverages that contain sugar. So we have here in red some countries which have enacted sugar taxes, essentially. It's also fair to note that the United States doesn't have a federal mandated sugar tax currently, but they do have a number of cities that have enacted sugar taxes, and I think half of them are in California, if memory serves me correctly. So essentially, many of these countries are imposing different types of sugar taxes. It's very likely these sugar taxes are going to increase in duration and magnitude and number of countries. And the ability of Coca-Cola and to a lesser degree PepsiCo to essentially be able to maintain the margin of their sales and really be able to pass sugar tax off to the consumer will be important for the company moving forward. Another risk PepsiCo has is that there's a lot of competition for private or store brands. And so essentially here's a picture of some store brands from Safeway. And essentially these brands typically sell at a 20 to 30% less of the actual brand name. And many consumers have been buying these products. It's currently predicted that 99% of consumers buy some of these store or private brands. And the ability for companies like PepsiCo to really create a product that can compete with these private brands and maintain customer share and customer loyalty will be very important for the profitability of the company. So just to give some final thoughts here, PepsiCo is a very defensible and diversified company. During this economic downturn, PepsiCo has maintained their margins and their revenues only decreased by about 3%. Furthermore, PepsiCo is a very diversified company in terms of both the sheer number of products they sell, but also in terms of geographical sales. The company also comes at a fair dividend and has certain growth potentials, but based on PE ratio, I would say currently it is on the overvalued side. There are risks with this company, including new government taxes and also competition from generic and private and store brands. But that taken together, I think PepsiCo is a very strong and solid defensible investment for dividend growth investors. I would please ask that if you did enjoy this video that you do subscribe, leave me a like, leave me a comment. I really appreciate all that. I do have a presence on Seeking Alpha where I write articles like this one and others where I provide more detail and more in depth here than the video synopsis. I would also highly encourage you to check out the description below and take a look at my articles. That would also really appreciate that. Just to share some disclaimers, I am not a financial advisor and this is not financial advice. I am sharing my financial journey for fun and entertainment purposes only. The models and graphs presented in this presentation are not guaranteed to be accurate, but I do my best. And of course, the stock market carries risks, so please consult a financial advisor and do due diligence prior to investing. Thank you so much. Hope to see you soon.